Today I'm going to teach you a strategy that can be profitable if the underlying asset, meaning Bitcoin, Ethereum, Solana, whatever it is, goes down or goes up by a lot. With one simple strategy, you can win on a downtrend, but also on the uptrend. This is called a backspread. Let's talk about it. So if you're new here, welcome to Bitopex. We are a crypto options exchange. So if you want to check it out, it's going to be the first link in the description. And if you want to know more about spreads, about advanced strategies for options, check out the channel. Here we cover from simple strategies all the way to copy trading strategies, to spreads, to advanced strategies. We in the near future will be launching margin for Bitopex. So your portfolio will have margin, meaning that you will be able to use multiple leg strategies together. You're going to be able to bundle them up and open a multi-leg strategy with just a few clicks. But in the meantime, it's always good for you to understand how these options work, how can you profit from them, what is the best case scenario, what is the worst case scenario for these options that we talked about. So advanced strategies, I've already made a video about it. You can check out the channel. We have a lot of videos here. We've made one with different spreads. We've made one talking about condors, butterflies, all these strategies that are very well known. But today we're going to be talking about the backspread. The backspread is a little bit different than the normal spreads because it uses ratio. It is kind of unbalanced. It is an unbalanced way for you to open a spread. Now, for spreads, as you might be familiar, you buy a call and you sell a call as well. And that difference creates a gap in maximum profit and maximum loss. So you're capped at how much you can make at most, but you're also capped at how much you can lose. So there is no liquidation. You get in knowing what is your maximum profit and what is your maximum loss. And the only thing that changes this is the break-even point. The break-even points being closer to the strike that you sold and the strike that you bought. So if the asset is above the strike that you sold, then you're going to be maximum profit. And also if it's below the strike that you bought, or vice versa, depending if it is a put or a call, you're going to be maximum loss. So for spreads, we actually have spreads here, easy spreads in a simple way for you here. So if you're watching here on Bitopex and you go to the Earn tab, what you're seeing right here, they're pretty much spreads. So we have vertical spreads right here for you to choose. We have a way for you to see on the bubble with bubbles right here, or you can see it from the charts. What are you looking at here? Well, this spread is simplified for you to decide based on where do you believe Bitcoin or Ethereum's price will be at a certain date. So right now we're looking at September 27 expiration. And here, do you believe Bitcoin will be below 58,000 by the 27th? Which for me, is just in less than 24 hours. Do you believe so? Well, if you do, you can open this right here, and whatever amount you put, if it is below 58, it can be 57,999. You're going to make 951%. So 9.5 times what you deposited. You deposited 100 bucks, you're going to make 951 in return, plus the 100 that you deposited, and so on and so forth. If you believe it will be above the 65,000, you can make 14.7%. And here we have all the other prices, and also for Ethereum we have all the returns right here for whichever option you want to open. So that being said, we know spreads, you buy a call and you sell a call, or you buy a put and you sell a put. But now we're going to be talking about backspreads. You're doing the same things as a normal spread, but in a different ratio. When for a normal spread, what you do is you sell one and you buy one. So it is a 1-to-1 ratio. So what do you do here? You do a 2-to-1 or a 3-to-2. It's just not going to be 1-to-1. So whatever other number, so maybe 4-to-1, maybe 3-to-2, whatever fits your current strategy and your current beliefs of where the market's going to be. So which one is the higher number and which one is the lower number? Well, for a callback spread, for example, the naming changes, but they always mean the same thing. So when we talk about callback spreads, call ratio back spreads, they all mean the same thing. Of course, there's a callback spread and a put back spread, but pretty much you're always going to be longing more than you are shorting. So you're going to buy more calls than selling more calls. And basically how it works, you're going to buy 2 calls out of the money, meaning that they are above the current strike of the asset. So let's say Bitcoin is now at 64,000. You're going to buy 2 67,000 call, and you're going to sell just 1 call, and that's going to be in the money. So below the current strike. So in this case, in this example, if Bitcoin is at 64,000, you're going to sell a 63,000 call. So let's recap. You buy 2 out of the money calls and you sell 1 in the money call, meaning now we have a 2-to-1 ratio. But what if I want to do it different? Well, you do a 3-to-2 ratio, or a 4-to-1 ratio, or a 5-to-3 ratio. Whatever that is, you do the higher number, you do that with the long part, the long legs, and the lower number, you do that with the short legs. So when do you do this? So this is a bullish strategy. When you believe the underlying asset will go up a lot. Right now, everyone is expecting Bitcoin to rally to the $85,000, for example. And you can see that because usually Q4 of halving years, they have performed very, very well. So October, November, December, they usually tend to be very good months for Bitcoin on halving year. Everyone, including me, is expecting Bitcoin to perform very well in the following months. So this strategy could be good. And why is that, Everton? Mainly because you have unlimited maximum profit. You're going to limit your losses, but you have unlimited potential gains. That is the difference between a normal spread. When you have a normal spread, well, you have limited losses. So you're not going to lose a lot. You're not going to get liquidated. You get in knowing what is your maximum loss, but you also get in knowing what is your maximum profit, which is not the same thing here with the backspread. Why? The backspread, as I said, you have unlimited profit potential because you have more long positions than the short positions. Again, this is why the ratio is different. So on one side, you have unlimited profit potential, and on the other, you have defined risk for your strategy. So you know how much you're going to lose, but you can make as much money as possible on the other side. And this one, for the scenario that we are right now, is also good because it helps when volatility increases. So if IV goes up, the premium of these calls that you bought are going to be juicier and are going to be higher and higher, meaning that the price itself of the option is going to be way bigger. But the downside is that theta is your enemy. So time is your enemy on this strategy, because again, you're going to lose money on that 2 calls that you bought right here. So what is the market outlook for this strategy? Is it good? When is the best case scenario? And when is the worst case scenario for the underlying asset for this strategy? So you do this when you are bullish. You believe Bitcoin will rally a lot. But when is it bad? What is the worst case scenario for this strategy? Well, the worst case scenario is that Bitcoin does not rally and does not fall a lot. We have sold a call at 63,000 and we have 2 calls bought at 67,000. So the worst case scenario is that if Bitcoin stays below that 67,000, that's going to be the worst case scenario for you. Because if Bitcoin falls below the call that you sold, well, you're going to be at least holding the premium itself of that call that you're sold. So let me show you right here the P&L that you should see, you should expect at expiration. So let's change these numbers for what we have right here. So right in the middle, we have $64.5 or $65,000 for Bitcoin. That is the current price or the middle price. So what you're going to do is you're going to sell 1 call, and that call is going to be $63,000. That is the strike that you're going to have. And on the other side, you're going to buy 2 calls at 67. So where it says 54, that is 2 calls that you're buying for $57,000 strike. And where it says 45 is 1 call that you were selling for $63,000 strike. And right in the middle, we have the current price, and the break even for the bottom part is the premium plus the strike. So the premium that you receive plus the current strike is going to give you the break even. So the break even is going to be 63,100, maybe something like that. And the max loss is right at the middle of these 2 legs. So right at the middle of these 2 legs, which will be 64,800, maybe 65,300. Between these 2 numbers is the maximum loss, meaning that if Bitcoin doesn't go anywhere, if it stays in the middle or between these options, you're going to lose money right there. But again, it is a maximum loss. You know how much you're going to lose at worst case scenario. So you can see right here that the worst case scenario is that Bitcoin doesn't move at all, because if it falls down below the call that you sold, you're going to be making some money. So you're not going to be losing money. You're going to be profitable. And if it goes up, you're going to be profitable as much as Bitcoin rallies. So if Bitcoin rallies to 70,000, you're going to be profitable. If it rallies to 75,000, you're going to be way more profitable. If it goes to $80,000, guess what? Way, way, way more profitable, because you have maximum profit, which is unlimited. This is the P&L of how this option looks. So this is the payoff of what you could expect at the end, at expiration of the strategy. But how do you set up these options? Again, same thing as I said before. You're going to have 2 options and 1 option. This is a 3-leg strategies, but 2 legs are the same and 1 is different. So again, the ratio is up to you, but the options that you buy are always going to have to be out of the money, and the options that you sell are always going to have to be in the money. Well, Everton, what if it is a put back spread? Well, now it is the opposite. You're going to still have the higher number of options out of the money and the lower number of options in the money. But now with puts, it looks different. Out of the money are buying puts that are below the current price, and in the money are selling puts that are above the current price. So for Bitcoin, this case would be selling a put that is at 65,000. In our example, Bitcoin is at $64,000 now. So selling a put at 65 is selling an in the money put. And then you buy 2 out of the money puts. How much would that be? Well, maybe you buy two $60,000, maybe $61,000, whatever that is. Just that number needs to be below the current price of Bitcoin. If Bitcoin is 64, whatever is below 64 is out of the money. You don't want it to be at the money either. You don't want it to be 63.5 or 64.5. No, you want it to be out of the money. So you go to 62, 61, $60,000 strikes. So this way you're going to be out of the money with 2 legs and in the money with 1 leg. And for a put back spread, you're looking at the opposite scenario. The payoff is going to be the opposite. You're going to be most profitable when Bitcoin falls a lot. So if Bitcoin goes to 0, guess what? You just became a millionaire out of these options. But if Bitcoin goes to 67, 68, $70,000, $80,000, 100K, you have limited gains. You're still going to be profitable, but you have a cap on how much you can make on the upside for the put. You see how that was different? For the call back spread, you have a limited profit on the downside and unlimited profit on the upside. For a put, it is the opposite. You have an unlimited profit for the downside and a limited profit for the upside. So you have to understand what market conditions we are in. And personally, now we are not on a place to do a put back spread. We are on a place to do a call back spread. Well, Everton, can I do that on Bitopex? Well, unfortunately, you cannot do it in a way where you can track all of these legs together, but you could do it. You could come right here, for example, on Bitopex where we are right now. You can toggle the buy option right here. And let's say I put December 27th, but you can go to whatever other strike that we have available. We have leaps for September next year, which is fantastic. And you choose a strike for these. Remember, you're going to buy 2 out of the money options. So let's say I buy a 70K and I put right here 0.3. Well, now I'm going to try to do a 3-to-2 ratio. So I buy 0.3 right here. It will cost me 2K on this side. And then if I switch to a sell, still on the call side, but I switch to a sell. And now we're going to sell maybe $63,000. So $63,000, and I'm going to sell 0.2. So here you can see the problem with this strategy. Because we don't have portfolio margin still, we just have single margin for each options. Now I would be required to have $4,000 here in capital for me to sell this option. I will be collecting $1,600 in premium, but I would have to lock up another $4,000, which we don't want. And when you do that in a portfolio margin strategy, because I have that 2 calls, it's going to understand that I can use those calls to protect this strategy. So I could open the 2 calls and sell the call that we have right now together, and it wouldn't require margin because the strategy has limited downside, which we cannot do. So unless you want to lock right here $4,000 until December to collect 1,600 and also to hold these 2 calls, which are 2K on top of the 4,000. So we would be spending $6,000, receiving 1,600 back and waiting for Bitcoin to rally up in price to then manually close all of these positions one by one instead of together. But don't worry, we are working on making the portfolio margin for you. So this way you're going to be able to open these strategies together. So you're going to be able to bundle them up together in a group and execute them together at a specific price. So if it is something that you are interested in, something that will make your life a lot easier, which will make my life a lot easier, subscribe to the channel, subscribe to all of our social media so you know when we launch these updates. Of course, I will be covering them here on YouTube for you. But if you follow us on Telegram, Twitter, X, whatever it is, on any other social, whenever there's an update, they are going to be launching there and I'm going to be covering here on YouTube as well. This is personally something I'm very excited to try. All of these strategies that I covered before that have more than 1 legs to choose my spreads myself instead of having the spreads that we showed right here on the Earn tab. This would be a very game-changing for us. So I hope you guys enjoyed, and I hope you guys learned something with the Backspread. It is a very interesting one, and it has a lot of potential, a lot of upside compared to normal spreads. So let me know what you guys think. And as always, thank you so much for watching, and I'll catch you guys on Monday. So have a safe weekend. Thank you.